Hello, hello, hello. Happy Friday afternoon, everyone. Another trading week is done. How is everyone doing? Did you survive the week? Did you survive April Fool's Day? This is April Fool's Day when this is being recorded live. I hope everyone did have a fantastic day. And yes, it is a classroom session. We will use some market examples. Uh, Going over some things, but again, we're not going to do a recap. If you want the day and week recap, that's going to be this Sunday at 3 p.m., which is virtually every Sunday unless it's a one-off case. It's always virtually 3 p.m. Central Time. Okay? By the way, if you're new here, please do consider subscribing, ringing that bell, and hitting the like button. Longer-term viewers, leave some comments, and definitely like this videos or just dislike them. I don't care anymore. You know what? I just don't care. I actually do care. I want to make good content for everybody. And, if you tell me it's bad or crappy content, I'll actually listen to it. I might disagree with you, but I will listen to it. Hello, Wavy. Glad you're here to learn. Good afternoon, Amit. Hey, Ken. Glad you're here to learn. The classroom. Yes, the classroom. Now, classroom sessions are important because I want to just reiterate stuff, especially with this current environment. I'm seeing too many people, again, think in terms of absolutes. Is this the top? Like, is this the top? Like, let me get my pointer. Is this the top? Is this the bottom? Is this, what is it? They're thinking bottom, top, up, down, bull, bear, instead of thinking of things in probabilities. That's the first shift I want you to start thinking about. And then we'll get into time frames because probabilities matter with time frames. But I keep getting these questions. Is this the top? Is this the bottom? Most of the time I will tell you I don't know, because it would be disingenuous for me to say it is a top or a bottom. There are probabilities associated with it if I have a signal associated with it. If I don't have a trading signal, I can't give you a probability. Then there you go, Jake. Let's go. Okay, so there are too many people out here, especially with the latest round of FinTwit gurus, that they're mixing up time frames. They don't even understand probabilities. They're making calls, and then they, if they're wrong, you don't hear from them about that being a bad call. If they're right, they say, oh, that was an amazing call. Look, I predicted it would go down, and then they just measure off the percentage instead of trying to teach people probabilities. Now, and I understand everybody doesn't have a system with probabilities, but you can learn based off your trading. And if you're logging your trades, and you're recording what the entry parameters were, not just I think it's a buy here or I think it's a sell here, but actually you have to have criteria. Why? If you don't have criteria, you actually can't log a trade. You can't categorize trades in buys and sells. That's a broad category, but that's not going to help you, because unless you only have one entry criteria, and you should be able to define it, it's not going to help you. Why? Because, all right, let's just go off stuff I talk about. And some stuff some of the rules, some stuff you don't yet, but stuff I talk about, percent B signals. Double bottoms. Let's just stick with those two. Two categories of trades. I can tell you percentages. I can tell you probabilities. And those are from back testing and from ongoing work. And how do you get the ongoing work? You record them. I don't just say I went long the S&P to a double. I don't just say I bought the S&P. I don't just say I sold Tesla. I say I bought the S&P in my trade logs. I bought the S&P because I got a percent B buy signal on this time frame. I went short Home Depot because I got a double top pattern on a weekly time frame. Why do I do that? Because after a number of trades, especially you shouldn't do it after 10, but hopefully, it might take a while, but once you get hundreds of trades or even 100 trades for each type of entry, you can start analyzing your probabilities. And also with probabilities, you need to come up with targets. Now, targets can be from, if people just want to do it off a reward to risk ratio or R multiple, let's say you're always just using a 1.5 target, a 2 target, which means you're taking your targets double your risk. Let's say you're taking like double targets. I tell you exactly what they are, so I can measure them out either from the aggressive or conservative side. But if you just say, I'm getting in this trade and I don't know what my targets are and I don't know what my stops are, you can't really measure anything. And then you can't think in terms of probabilities. And if you can't think in terms of probabilities, you're in a binary mode, and every trade isn't the same. All right? This is where people get stuck with stuff, and it really can damage their trading long term. And I know this is a slightly advanced concept. It's not really, it's simple in its concept, but it's advanced in its application. And I'm putting this out there, you know, and I imagine a lot of people won't get this concept. And I applaud you if you can start thinking this way, because this isn't something sexy. This isn't something, here's your, what was I looking at? Here's 237 profit in 2.5 months. Okay, that's, you know, forget it. You know, just when you see stuff like that, you start to do really serious due diligence and start asking questions. What's your time frame? What's this? What's that? What's the other thing? Okay, what's this? Was it tested across a lot of different things? Was it this? You know, that's sexy. That's a sexy headline for bringing in subscribers, bringing in views. This is not a sexy headline. Think in terms of probabilities and time frames. What does that mean? Well, let's go through a couple things. Here. But this is going to help you more so than anything else, or one of the things that can help you majorly. All right, and I'm just going to use this as an example. We ran up here. All right, and this was still horribly sloppy, even with the spike in the middle, horribly sloppy double top. It still does qualify. It's slightly lower probability because of spike up and that's from a ton of testing. That's from thousands of examples. But look, where was this? This was at the end of March. Where was this in terms of this? In terms of our bigger daily, that was up here. You see up here? You take off some of these lines real quick. So, was this the top? No, it was a top. What did the probabilities tell me? The probabilities said we have X percentage and it's in the upper 60s for the final target to reach that final target. Does that mean we are going to brand new lows? We could. Could this be the short-term top? Yes. Did this tell me this pattern? No. It is a top. Could it turn into the top? But this pattern, based off a 1-hour double top, did not call a long-term market top. All right, there are market tops up here. Okay, this is technically a double top pattern. Did it call this move? No, it did not. It called a portion of this move, just like this little top called a portion of this move. So what I see people getting in trouble with is they see this, and then they put on, all right, we're bearish, you know, Mike's got long-term signals that are bearish. I'm going to put on a major put position because we're going to new lows. No, we're going to new recent lows. We can measure them out, but that doesn't mean we're going to absolute lows. This afternoon, this was a double bottom. It had probabilities associated with it. It had probabilities to get to 45.27, spiking up there, resistance. The trade was over at those probabilities. Let's say we go to new highs next week. Am I going to be out there saying, Oh, look. Hey, I called on Friday afternoon, April 1st, April Fool's Day. I called the lows. We're going to new highs. No, this was a short-term low based off a 5-minute time frame. Could it go to new highs next week? Yes, we are in a daily rotation zone. Could we get another signal that says we're going to new highs next week? Yes. Was it that signal? No. Should you be putting on we're going to all-time highs because we got a 5-minute double bottom? No. There's probabilities associated with the trade, not an absolute. Let's just see. Let's get through some questions. There's one thing I've learned about the market. It's all about probabilities of where one thinks a stock could be going. If this is then the probability is this. And yes, it's all in terms of probabilities, and it's not where you think. Again, you should have some kind of results based off your entries or testing. And they can vary slightly over time, and they will vary slightly over time. But again, I have a system. I'll go in here. Let me talk about something else real quick. I have a long-term system, right? I have a couple of them. One of them is only triggered 5 times in its history. And it's 100% for certain probabilities, for certain major moves. It's triggered again. Will I tell you it's 100%? No, I won't, because it's 5 instances. I would be insane to tell you it's 100%. It's been a 100% track record, but I won't even say it's 100% because it's 5 instances. Could it be wrong tomorrow? Could this be the case it is wrong? Sure. I'm going to trade it with those probabilities, but I'm not going to trade it as 100%. Why not? Because it's limited data. So it's like saying I took 5 trades based off of X pattern that I learned on YouTube. They were all right. It's got 100% probability. No, it doesn't. You have 5 instances. Unless you've back tested it yourself, even if somebody says, I did 100 tests with it, blah, blah, blah. You need to do your testing based off of what you trade, your time frames, and everything else. The system can work great on a 5-minute chart. It can work horribly on a daily chart. I try to put out stuff that works across multiple time frames because I think it's more beneficial. This channel deserves more exposure. I shared it with my Reddit group. Spread the word. Well, thank you. Thank you, Strategy Freeman. Welcome, welcome, welcome. Mike, you have to be a robot in human force to remember probabilities. No, you don't. Well, I've done this for so long, but you don't have to be a robot, because once you start knowing something, you start trading it. Let's say you have a MACD entry. A MACD, I trade the MACD on a daily time frame, and I've done it for a couple years. You should be able to go back with your trade logs and tell me what the exact probabilities of your win percentage based off a certain reward to risk. If you can't do that, you have a problem, especially if you've been trading more than a couple months. Because even if you're trading more than a couple months, you should at least be able to tell me what your track record is. And you don't have to tell. I'm not asking for people's track records. I'm saying you should be able to say, I'm logging my trades. I know this is my entry. This is either my target or my reward to risk ratio. This is my stop. This is how I've done over my last 50 trades. There you have probabilities. And you also have targets and stop levels. So you know your probabilities based off your targets and stop levels or your reward to risk ratio. So you should be able to cite that. Could it vary? Could you be at 58% probability winner right now with a 1.4 reward to risk ratio? Yes. Could it be 62% after 20 more trades? Yes. Could it be 55 after a few more trades? Yes. But longer term, you start to develop a probability set and a probability mindset, or you go and test your stuff, whether you can write it in a script or whether you have to do manual back testing. And that will at least give you some probabilities, and then you have to vet that out with actual trading, because you can get confirmation bias and everything else when looking through stuff back testing. But if you can't do that, you're already behind the curve. And if you're just saying and if you don't even go that far to log your information, and you can't come up with probabilities, target stops, or reward to risk ratio, then the chances of you being a successful long-term trader or investor diminish greatly. And why do I see people now worried about, this whole time I rarely saw people worried about the probabilities of this being a top. Everything was just a short-term top, and everything was just a pullback. Okay, but now people are worried because we have different market conditions, and there's still, based off long-term stuff, there's probabilities, and it's pretty high that we will go lower. Could it be wrong? Yes, that's why it's not an absolute. How do you trade that? You have to trade according to your probabilities. And you also have to understand, this is where time frames get interesting again too, because I see a lot of people over-leveraging especially with options. And they don't have probabilities in time frames. So you're running into a world of hurt if you're trying to always ask, I just loaded up real big on this. Was it the top? Is it the top? Or are we going higher? Again, if I had a little signal up here, I don't have a long-term signal up here besides the long-term signal that's already been in place. I can't tell you. It's like I got questions yesterday. Is this going back to 60 bucks? I don't have a signal. Can't tell you. Here's your probabilities. Now there's probabilities with rotation zones that you can test out and everything else. That's why I use those concepts. But is it always... There's not always a signal. There's not always something else. Another thing I want to point out. If you say you have a long-term signal that calls tops up here or bottoms right down here, you're a liar. And anybody who's saying that is pretty much a liar. Why? Because they're mixing up short-term signals with long-term signals, and they're looking at it in the rear view mirror. Because I have plenty of short-term signals. There's topping patterns here, there are topping patterns here, there are topping patterns here. But can I say it's a long-term top? No. Why do I have a different, and I'll just go back to this one. Is this kind of system, based off long-term probabilities, going to call a top here? No, it's going to call a top down here. Is it going to call a bottom here? No, it's going to call a bottom in here. Why? Because your probabilities shift with price action. And you're not going to have a long-term signal, a system that calls this. And was this a top? No, it was a short-term top. Was this a top? No, it was a short-term top. Was this a top? No, it was a short-term top. This was a longer-term top, but you could only know that in the rear view mirror. But you won't have a long-term system that calls this as a top. You will have a short-term system that calls this as a potential top. You get the longer-term confirmations much lower. So another thing, if somebody's trying to sell you or market you a long-term system based off, it's called this top and this bottom and this top and this bottom and this top, and those are the only instances, they're full of crap. They are absolutely full of crap. Why? Because if it was calling this top, this bottom, it might have called this bottom, it might have called this bottom, it might have called this as a top. It's not a long-term system. It's a different time frame system, but people recategorize stuff based off of what's happened. It's like what was that Alan Greenspan? You only know a bubble once it's popped. That's a paraphrase. I don't remember what the exact quote is. It's sort of like people who say, I called this top. And if I came out here and said, I called this top based off of 1 hour time frame, that's a load of crap. It's a complete and utter load of crap. Because a 1 hour time frame is not going to call a long-term top or a or a long-term bottom. It's going to call a potential top and a potential bottom based off a time frame, and there's probabilities associated with that. So if you take away one thing, if you want to distill this down, well, I'm actually going to say a couple things. Start thinking, get away from absolutes. Is this a top or bottom? And start asking yourself, is it a top or bottom? Potentially on what time frame? In what are the probabilities associated with that time frame versus another time frame? For example, this, remember the double? on Home Depot, the weekly double, has a much better probability of the lower prices than a 5-minute. So look, you even had a little mini double up here, but that did not call this. This, once we closed below it, called this. This did not call this. A 5-minute double has still very good probabilities, but it does not have the same exact probabilities as a weekly double. All right, longer time frames are more important than shorter time frames. It's why for longer term systems, I want to look at weeklies. For shorter term things, I can look at dailies, 4 hours, but even down to 5 minutes. But a 5-minute system is not going to call a major weekly turning point. So don't mix that up. Hey, hello, 42 Lou. Thoughts? We're not going to do that today, William. We'll do that on Sunday, okay? I'm not going to do individual stocks. Glad you are back, Lou. Is there a 60% chance I am correct 30% of the time? Fantastic. So if there's a 60% chance you're correct 30% of the time, what's your overall probabilities? Because you can actually figure that out. Difference between crypto and GameStop investors. Crypto investors are intelligent with a goal to sell to the stupid. GameStop investors are stupid with a goal to sell to the intelligent. Okay, and I'm going to go into something now that you brought up GameStop and AMC and other stuff that goes these vertical up, vertical downs. Why do I hate trading these patterns? Why do I actually find these patterns horribly unreliable? Why? Because your probabilities on these kind of moves, when you have multi-sigma moves, you actually have the probability shift to a reversion of the mean. The problem is you don't know when the reversion to the mean is going to happen. Exactly. The timing gets harder because it's not normal trading. It's even not, you have fat tails in these and you have high sigma events which favor reversion to the mean. That's why you get vertical up, vertical down. So these can be great for juicing stuff, but they're actually horrible to trade. They're exciting. Oh, look, I made 58% in one day. Well, fantastic. But the odds of you keeping it versus giving it back, your timing has to be impeccable. It's why everybody shifts. It's great. Look at the explosion. Oh, there's a short ladder attack because it's reverting. All right, because people don't understand the way markets work. These probabilities suck to identify great trades because you have multi-sigma events that favor reversion of the means but also have fat tails. That means they can continue longer than you think, but when they stop, they favor a rapid return to the mean. So that is crappy trading. Just point that out. Why? It's just because you have the fat tails and you have the reversion of the mean on a multi-sigma event. That's also why when you get stuff really stretched out in any market, it favors a reversion to the mean. Let's see. Speaking of questions on probability, take a look at net on the 15-minute chart. What happens to the effectiveness of the rotation zone components when the rotation zone flatten out that much? And I'm only looking at this for the purpose of an example, not to do analysis. Sorry, I switched the wrong chart. This is what I've talked about this before. When the rotation zone flattens out, it means it's in consolidation. I cease to use it. It's no longer, is it rotating? Not really. It's in consolidation. What are you going to watch for? Now I'm going to shift to my probabilities on a breakout versus breakdown of a horizontal channel. And I do have probabilities on those because I've traded enough of them. Okay, but I'm not going to, now, you take it to a different time frame, you still have probabilities to the upside. Why do we still have probabilities to the upside? On net, we still have a larger term, double bottom, which is pulled back to the breakout zone with a rising daily rotation zone. There are probabilities associated with that. This, there's not probabilities associated with the rotation zone. There's probabilities now associated with the horizontal channel. And by the way, if you don't know what those are, you shouldn't be trading them. If you don't trade horizontal channels, there's no trade there. Is there a potential trade still on the daily? Yes. Should you be coming up with a trade on a... Remember, every pattern isn't your pattern. Every trade isn't your trade. That's something else. This, you can see it even on the 1 hour. Horizontal channel. So there's breakout and breakdown pattern probabilities associated with that. And those breakout or breakdown, I bet you can guess which it favors. You still have a 4 hour rotation zone. You still have a daily rotation zone. You have a long-term weekly. You might not be able to put a probability with it, but based off this, where do you think the probabilities lie to the downside or the upside? And it's not going to be 50-50. It's going to lie, I'll tell you right now, to the upside because you have the longer term rotation zones and you have the longer term patterns still in play. Is that a guarantee? Should you go, I'm going to back up the house. Mike said the probabilities were to the upside. We have a weekly double bottom, albeit sloppy, a weekly double bottom. I'm backing up. I'm going to take half my account and put it on a call spread for next week. No, you shouldn't do that. You shouldn't do that at all. Just because it probably favor an upside breakout, you back up the truck and say, I'm putting even 10% of my account on this. No. Why? It's not 100% probability. Let's see. We can cover that on Sunday afternoon. I'm not going to get into specific plans with stocks right now. This is a classroom session. Can you touch on how you use the MACD? I've read and seen how it should be. I will talk about the MACD briefly. It has its uses. Do not use the default parameters. The default, it was popularized by George Angel in the 70s with a book he wrote. From all the research I've done with it and all the testing I've done, the default parameters, they were essentially curve fit to data in the 60s because it even starts falling apart after his book was published in the 70s with the probabilities. If you actually do the testing, that's where curve fitting is very dangerous. MACDs can be utilized. Do not use them with the default parameters. Okay? Because they don't. It's just like the RSI can be utilized. Don't use it with its default 14 period. It actually does not test out well with the default 14 period. The period is the problem. The MACD, the default parameters are the problem. That's where you get into probabilities. Just because people cite stuff, they don't know. Now you can come up with it with your own. Again, you don't always have to backtest. If you want to just try trading something with a small account and generating a track record and coming up with your probabilities based off that, that's fine. I don't care how you test it or come up with the probabilities, but if you're not even willing to properly log your trades and try to come up with probabilities, again, you're behind the curve because you are going to think in terms of absolute tops and bottoms, absolute moves, and there are no absolutes. Everything is a shade of gray, just like the probabilities on the weeklies are different from the probabilities on the dailies, which are very different from the probabilities on the 5-minute. Hey, Danjet. Oh, this is the two people I'm sponsoring for Discord yesterday, William S. and Coco. Coco has joined, and William S. I'm still waiting to hear from with the email. Email me, please. Will you show us how to use limit stop loss? Because when I do it, I think I do it too close from it or too far that I lose more and I'm not planning. Okay, I come up with my stops First off, I'm going to give you a broad stroke answer. And this is also ties in, this is a good tie-in because as I've talked about probabilities, it comes with reward to risk ratio. And you know, I don't blindly follow a reward to risk ratio. I have a minimum that I won't go below, but I base my targets and stops based off price action and harmonics. Why do I base them off price action and harmonics? Because I found it works better, A. And B, I want to know where my stop is based off where price action tells me it's wrong. All right? So, and then how do I deal with that? This is another thing, and I'll have to do another classroom session again on this, which is position sizing. If your stop's farther away, you're going to trade with a smaller position. If your stop's closer, you're going to trade with a larger position. Why? Because you can base it off risk. And you're going to want to take the risk based off a certain time frame or a certain system. You're going to want to keep your risk consistent. So if your stop's naturally farther away, that's where people say, I don't like my stops being that far away. Why? Because I'll lose more. No, you just reduce your position size. So if it hits that stop level, for example, I've talked about this before. If I'm in a $100 stock and my stop is at 95 and I want to risk $1,000 on that trade, I have $5 at risk per share. Okay, at $5 risk per share, I can trade 200 shares. Why? If it drops from 100 where I entered to 95, I've lost $1,000. Correct? Now, if my stop loss was at 90, because that's where the price action told me I was wrong, could I trade the same number of shares? No, not from my way of trading, because I'd have to cut my share size in half. Why? My stop loss is $10 away. I only want to risk $1,000. Now I can trade 100 shares. So that 100 shares goes against me. I lost it stops me out at 90. I still lose $1,000. So what does that tell me? First off, that's a major concept that a lot of people can't get their head around. You vary your position size based off where your stop is going. So you're keeping your risk consistent because if you knew which trade, even in a probability set. So let's say I have probabilities of 70% on a daily time frame of whatever XYZ system working. I don't know which 70% are going to work and which aren't. Because if I did, you think I'd take any of the 30%? So, and there's still, even if you said I have an amazing filter, there's something like, all right, I'll give you an example yesterday in crude. We had a probability on first we had actually two back-to-back trades. We had the head and shoulders, which they announced a strategic reserve release. And then we had a double bottom, which then the next day, another thing came out, with their exact release schedule and everything else. Both those were stopped. Did I know both those were going to be stopped? No. Were there decent probabilities associated with both those trades working out? Yes. Could I have predicted the exact timing when they were going to announce those things? No. So nothing is 100%. And if I knew going in that they were going to announce that and the market would sell off, do you think I would have taken those trades? No. But that's not the way trading works. That's not the way it works at all. So, back to the stops. I do it too close or too far. Well, you need to learn price action, how it affects your stops. For example, I'll give you another little clue, and you can investigate this yourself. And this is where it drives people crazy. It literally drives people crazy. All right, we have a sell-off now in the S&P from the highs back on the 29th of March to the lows on the 1st of April so far. I have my harmonic retracements on here. Where does this really shift? Now, longer term, we're still in an uptrend. Very long term, we still favor lower prices. But where does this shift that we're going to retest this highs? It doesn't actually shift from all the testing I've done until we get a close above the 62.5% retracement level. Why? Because anywhere up here can still favor a rollover. I'm just going off this down move on a certain time frame. All right, don't get nitpicky with this. So, but people say, well, all right, I'm short. Where would you put your stop? Above here, but that's too far away. Okay, then you have to go, if you want to go off price action, then it should be above here. Oh, that's too far away. Well, then you have no, then what am I supposed to tell you? Because a lot of people want their stop. I got short on this bar. I want it right here. You know, unless you have an amazingly highly accurate system on a very short-term time frame, your stop's way too tight. So you're actually lowering your probabilities because you're trying to keep way too tight a stop. But people don't, again, back to tide. Let's say you say, all right, I need a stop up here. So you lower your position size versus stop here. You need a stop up here, you lower your position size even more. You shift it with the probabilities. Why do I say I would not have a stop here? Because there's no probability that favors a significant stop here this close. Let's say I shorted right here. So look, where I come up with when I'm testing stuff out or developing things, where is it wrong? Which generally means where does the probability shift that the trade is no longer valid and the probabilities are not in my favor. I'll give you another example. Let's say we came up here and I got a double top right up here against the 62.5% level. Can I keep a really tight stop? Yeah. Why? Because the probabilities are, you get a close above here and above the double top. The probabilities are the trade is wrong real close. But that's a different nuance because of where price action is dictating the trade is wrong. The trades between getting short here and getting short up here have two different sets of stops and two different probabilities, and therefore the stop and your position size are going to be different. So if you're trying to figure out what trading, first thing to do is and start analyzing, and this you're going to have to do this also with your trade if you're not good at testing or don't have system testing or don't want to spend the time doing it manually. Start looking at where does the thesis for me getting in become invalid, and you come up with your stops based off of that, and then you start testing them out. So therefore, over time, and I want to reiterate this. Don't judge the stop based off the amount you're going to lose, because you can change the amount you're going to lose by reducing your position size. Now you can say, well, I'm trying to trade and I can't get below one share or one contract based off my stop where it needs to go. Then you can't take that trade. You don't adjust your stop to take the trade. You don't take the trade. It doesn't fit in your parameters. Because your stop is where the trade is potentially incorrect at a higher probability. So if you can't put your stop there, why would you move your stop to a level just so you can take a trade when that level might not mean anything statistically? Let me know if that makes sense. That's why people just blindly saying, now, if you've tested something out and with the system that there's, all right, because I'm not going to pick on it that much because at least people have reward to risk ratios and they can do stops just based off of, look, I'm going to take a 15% stop and a 30% target. 2-to-1 reward to risk ratio. I don't think that's the best because you can definitely refine that with price action, but at least that's a major step ahead because you have probabilities associated with you taking those kind of actions. Because if you do that trade 100 times, you will start to develop and look, I took 62% winners and 62 out of 100 winners, 38% losers based off those parameters. At least you have something to go off. you have probabilities, and those probabilities are tied to that 2-to-1 reward to risk ratio. They're not tied to anything else. If you then say, well, boy, I have 62% winners, I'm going to a 3-to-1 reward to risk ratio. Your 62% doesn't matter then, because you've just changed your reward to risk parameters. So you have to retest or go back with your track record and say, what happens if on each of these trades I went to a 3-to-1? Or what happens if I went to a 1.5-to-1? Or I like to do this with trades. Let's say you're trading something and then you go, I now have my trading journal and trading spreadsheet, especially trading spreadsheet. I have 100 trades based off this system. Let me see. Let me go back and see what happens if I used a ratio versus fixed targets based off of like the way, well, I do a lot of stuff with harmonics, or stop losses based off harmonics, or stop targets based off of clear path moves, or targets based off of this, or swing highs and swing lows. Whatever it is, you can at least go back and say, off these last 100 trades that I did 2-to-1 risk reward to risk, if I got into that same place and instead used the targets of harmonic extensions and the stops of harmonic retracements, and I redo each of those trades, is it better or worse? Might be better, might be worse. But then you'll have a new set of probabilities based off those characteristics. And then you can start really refining your trading. Versus off thinking a 5-minute or a 1-hour double top is going to call an all-time top. No, it's going to call probabilities to a certain target. It's not going to call an all-time top. It's not going to call an all-time bottom. Could that be an all-time top or all-time bottom? Yeah, but your 1-hour system did not call it, because you don't have probabilities based around that. And if you did, they'd be minuscule. Because if you're in the scope of trading the markets, let's just take the S&P. How many years has the S&P futures been trading? How many times do you think a 1-hour whatever, a 1-hour XYZ pattern has called an absolute or a major high, let's say a major bear market high or a major bull market low? It's going to be minuscule in terms of all the times that thing triggered. So could it call that? Yes. Is it probable that every time it fires it called it? No, it's micro probabilities. Uh, 62, yeah, that was back on the, again, why, and Sterling I know has done a lot of work with gap fills. Hey, Sterling, gap fills in the 62.5% level, how well do they work? Let me know that. One market order can stop you out. The stop is too close. Yeah, again, this is why your stops, and I'm not telling you to trade my way. I'm not, that's why I even haven't put up a lot of systems for sale, because I actually, I'd rather people do their own thing, but I see still a lot of people wanting it. So I'm working on it. What I think I'm going to do, by the way, give me some feedback. I was thinking instead, I keep recording them and I don't like the way they turn out. What would you guys think if you wanted to sign up for, we did live sessions and I recorded them, and it would be a paid for a live session, but they'd also be archived for everybody. But the benefit if you got it live with me is you could ask questions. And then I just archive those for sale. Again, I'm not trying to, I'm not turning this into a sales thing at all. I actually want to just teach people for free right now. But for the time I do that, I need to be compensated for some system stuff. On the ES chart you have up, has the bottom channel line also turned into another area of significant resistance on an upward move? You mean, has this turned into, yes. This bottom has. Remember I talked about this morning, I'm just going to lump back in if you don't know. Remember I said my favorite move was a retest, not the first break of a channel? Here was the first break, and this was actually triggering as we were wrapping it up. And the actual trade, because I was still on the live stream, was on this bar because it had to retrace. But this, remember I talked about break of a level and a retest? Break of a level and a retest and a roll over. So you think that channel is still significant? Yes. Now, would I just take it by itself? No. why I will watch for another area, like depending on when we get there, for example. And this is stuff you guys can test out too. Let's just say we skyrocketed up. This would be the area I'd be watching. And so this would be the area right off the bat I'd be watching. And why would I be watching this? For a number of reasons. And I know this from years of doing stuff. See just how I came up with this? So is this an area of significance? Yes, but I'm going to fine tune it because I have prior price action right there. I have a harmonic, and now I have this. So if this is going to rally up on Monday, could I watch for a short-term topping trade there? Yes. Now, again, to tie it into the section of this lesson, would that be a topping trade that would take me to lows below this low? No, it would not. Sterling, so this is in reference to the 62.5% level, about 78% from what you've tracked. Yeah, and it's in the 70% from what I've done too. That's decent probabilities. Can you turn that into making money? Yeah. And I've given that away. Here, you do retracements and do gap retracements and do just move retracements. Once you get below that 62.5 on a closing basis, it favors continuation of that price action. Okay, I'll take a look after this, William. So that doing it with the live, I think that's me teaching some things live and then archiving them for sale. And we do it that way. I think I might do that. It might be a little rockier, just because it's live teaching, and I won't be able to edit it as much without a lot of time, but I think it will be better because I think I'm actually better at teaching live than recorded. At least if you don't think I'm good at teaching live, then please tell me. I'd really rather have honest opinions. Perfect example of the time frame significance in trading was double top in the double bottom trades. And yeah, I was going to call up a firm. By the way, if you're not in Discord, and I know Sterling did put this in. I don't use the 61.8 Fib. I use the 62.5% harmonic. It tests out better than the 61.8% Fib. It tests out actually a few percentage points better. I think the harmonics test out, and I'm a huge Fib fan, but harmonics have tested out better than Fibs. I think is actually the market moves more in the harmonic sense of view than it does this Fibonacci sense of view. It just so happens that you have some harmonics and Fibs very close. Like you have a 25% harmonic and you have 23.8. You have a 37.5% harmonic, you have 38.3. You have a 61.8% Fib, you have a 62.5% harmonic. You have a 74 something Fib, you have a 76 something Fib, you have a 75% harmonic. So they're roughly similar, but the harmonics have tested out better. Here's what Sterling was talking about with a firm. So again, here was a firm. Let me show. He posted these straight in. Double bottom. Let's just take a look at the big picture. Let's take a look at today's price action. You see today's price action on a firm? See this? Did it go anywhere? I mean, we had an up and a down move, but look at the open to close. Wow, that's an exact doji. 46.61, 46.61. But look within that. You had a double bottom. Okay? Was that a bottom that says, even though this was in a rotation zone, rotating back up? Does that double bottom say, I get long on a 5-minute time frame for a move back to 74? No. You'd be trading a different strategy you'd be saying, I'm getting long here based off a rotation zone buy for a target up here, and that would be on a daily time frame. For example, if I was trading that on a daily time frame, where does my trade become wrong? Well, we start dropping below this swing low and the rotation zone. My rotation trade is incorrect. So I know where my stop placement roughly has to be right now. Correct? So my stop placement, let's just go off here. I'm not, and I don't put it on round numbers. So 39.95. For this, I'm going long on a rotation trade up. Stop at 39.95. Target, well, again, so short-term targets to raise my my stops, or I'm going to focus on short-term target to raise my stops, 54.67. Longer-term target, 57.86. Why it corresponds to this gap and a harmonic. Do I have reward to risk based off of I need a minimum of 1.2 to 1? Hypothetically, I'm just making stuff up with that ratio. So now I do my calculations. I get in at 46.60. My stop is at 39.95. My target is 57.85. Do I meet my reward to risk criteria? Yes, take the trade. Now, 5 minutes. 5-minute double bottom. Do you think I put my stop, which is where it triggered, 45.86. If you're doing it on a break, 45.78. If I'm getting in at 45.78 off this pattern, do I put my stop down here, 39? No. That would be absolutely ludicrous. Why? I wouldn't put it at 39.95 because now I'm mixing things up. Even though so I'm not trading this 5-minute based off a daily rotation zone. I'm trading this 5-minute based off this probabilities of this move. So look, my target's 47.14. Okay? So I need to have a stop based off my reward to risk ratio and my probabilities off this pattern. And my target's being up here. It's not a target to go for that gap fill. It's a target to go up here. And then, conversely, what's this? Double top. And if you use conservative or aggressive, that's a nuance. This we'll just go off conservative. Here's the target, 45.32. We go back to the daily. Oh wait, it came off the 50, and now we're getting a little double top pattern. So I'm going to put a stop up here for my double top pattern of my 5-minute trade. No, 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 no. Your stop, and I've given you enough clues. I mean, worst case, your stop's up here, 47. Worst case. So time frames and probabilities. And does this, because you had a double top there, does you go, oh man, I was going to take my daily rotation zone trade because it's a continuation of a move. I got my targets. I'm bullish on this. It's come back. It retested its breakout level from here. Look, prior time broke out from here, moved up, rotation zone, came back, retesting breakout level. Fine. Let's say that's your system. Now do you go up here and say, oh, I was going to get long, but man, I had a 5-minute double top. Forget it. My daily trade's out the window. Forget it. No. That was a 5-minute trade. It didn't invalidate anything you were doing on a daily. So, I think I'm going to wrap this up soon. Oh, well, thank you. Thank you for those kind words. I'll have to do another classroom session on that, John. It's a harmonic. I use 12. Here, I'll just give you a quick clue for anybody wondering since I've talked about them. There's harmonic extensions, which are just 12.5 and 25%. Okay, and I'm using a Fib extension tool. And you want to go from a significant swing low to a significant swing high and go to back those harmonics, 12 and 25%. So in TradingView, it's click, double click up here because that gives you don't want a retracement extension. You just want an extension from the high. This is an area I'll move up a stop. This is an area I'll move a stop or take profits. And they're used in a lot of other ways in systematic stuff I do. Retracements, I use the Fib Retracement Tool. Again, instead of fib levels, here are the settings, 12.5% increments. So instead of 61.8, I have 62.5. They test out better. Now, where would this, on a longer term basis, let's say I was like looking at something from a weekly perspective. I don't have a trade here. I'm just hypothesizing. All right, there's a trade into the weekly rotation zone. I'm targeting 65 or 63. I'm targeting here. I'm just making something up. This is not a trade, so don't use it. Where would my trade be wrong from a longer term perspective? Well, I know once I get a close on a daily basis below that 62.5, it favors a retest of this low area down here. Its probability, statistically, it has that's upwards to close to 80% on a daily and weekly time frame. So where do you think my stop is for a longer term thing? Why could we pull back? On a weekly basis, could we pull back even more? Yeah. Where does my trade become wrong? Below this level. So now, do I want to stop based off a big weekly time frame right here? Not in your life. That would be insane. Why? Especially you could always pull back to the 50% level of this up move. I think people have looked long enough to see how important a 50% level is, and that's the same in Fib or Harmonics. It's a fantastic level to utilize. Do I want my stop above there? Worst case, no. Why? We could pull back and resume the trend. And again, this is no trade. This is hypothetical. But that's the way I use the harmonics on retracements. And I like to trade between them on a closing basis. You can see how it stair steps within harmonics. And it's great for trading around core positions. It's absolutely fantastic for fine-tuning levels around core positions. So that's just a little primer on harmonics, retracement, and extensions. Yeah, if you want to join John's, Sterling's saying he will cover it. We're trying to build this, and Sterling's a great part of this community. Yeah, it's going to turn between the fifth. The probabilities, as long as it does not close below. But how many times have you seen Sterling? How many times have you seen pullbacks between 50 and 62%, and then it resumes its trend? How often have you seen that? Between those key levels, which is a fantastic trade, by the way, and then it resumes its trend. So do you think I want to stop above that level? Not in your life. So that's how I use those things. Yeah, most of them. Now, again, is it 100%? No, because you could get a little short-term up move and then it could roll over again and go down. It's not 100%. Nothing's 100%. If you're looking for 100%, you're going to be in a long, lonely search. Remember this, for everybody who follows the thing, what was the level I was watching on the crude? On this up move. 62.5. Look where we had a down move, the retracement, and look where we rolled over. We could not get a close above here. We rolled back down. What does that favor? A retest of this low area between the 12.5 and the 0. And look where we've retested. If we had closed above here on a daily basis, what would I have been targeting? Something completely different. So we've done a lot besides just probabilities and time frames, although we've covered even time frames more and more in this. So I hope this is making sense. I really hope this is making sense, and why I want people to start at least getting your mindset around here, which is a tie-in, which is why you need to track your trades and have a proper trade log, and you don't just lump them all as buys or sells, because they should not be all the same buy or sell unless you only have one method of entry and exit. Otherwise, all your trades are not the same. And you should categorize them by time frame. Because something you could be doing on a daily or 4-hour basis might be working at like 65%. You put it down on a 5-minute basis. Let's say you trade it for a while and it's coming out at 38%. Do you want to trade that on a 5-minute basis? No. Can you still keep trading on a daily and 4-hour? Yeah. Some things just don't work across multiple time frames very well. Other things do. But you won't know that if you lump everything together and don't filter by time frame and by entry method. And you need to record your reward to risk and or your stop target. If you have a stop and target, you can work out your rough reward to risk ratio. If you're just using a reward to risk ratio, then you need to track that, because you don't have probabilities without the surrounding parameters. And then I'll wrap this up. And what are your surrounding parameters? Just to reiterate, your time frame, your entry and exit method, your target stop and or reward to risk ratio. Without tracking all of that, and I don't care if you're a beginner or advanced, if you're not doing that, you're severely limiting yourself. And if you're a beginner or intermediate, you will probably end up not being a long-term trader / investor. I mean, you might be a long-term investor just because in a bull market, you just buy stuff. But that's not really a targeted investor. That's just buying stuff. So if you're not doing that, and if you want further, let me know if you want further elaboration on that. Because about everything I just talked about with that trade log. And, you might only know one strategy so far. Use it and log it. But then you'll be able to know how well you're doing, and you'll be able to go back and vet everything. It's how Sterling can start citing. He probably doesn't have 10,000 of these under his basis, but he's got, I imagine you have in the hundreds at this point with the amount of chart work you do. So if he is in the hundreds and is coming up with these probabilities, he's got a good percentage. Hey, this works. This works. Could you go into a losing streak? Could you get 10 losses in a row? Sure you can. But I know if I'm sitting there with 68% or 70-something% probabilities, even if I have a losing streak, okay, it happens. It happens. Sterling, all right. 183. Did you just make up that number? Just kidding. That was a joke. I'm not getting into MACD today. It's actually not one of my favorite indicators, but I will consider that in the future. So Sterling, actually, you think if he's tracking his stuff, he knows exactly. He's got 183. By Monday, it'll probably be 185, depending on what it is. Whether that's the doubles or the gap fills or whatever. But he's got stats. And stats are super important because they help you when you have that losing streak, when you're questioning yourself. For example, two losing trades in a row in crude. Oh, I give up. I'm never trading crude again. The true losing trades are just two losing trades. And if you're not over leveraging your account, then they're just two losing trades. If you're over leveraging your account, then go back and watch I think it was last week's classroom session. Don't do that. Don't, because you don't know which trade's a winner. You don't know which is a loser. I only have a 12% probability that there'll be new highs this year in the S&P. Could we still make new highs? Yes. Should I bet everything on the fact that we won't make new highs? No. Can I do a larger bet Slightly, yes, because 88% probability is decent. And there'll be a time I put a larger bet back on. Short term, we closed above the 62.5, so I'm watching for continued higher prices. In the short term, we get a double top and it triggers, that will shift the probabilities again. But guess what? Do I put 50% of my account on, I got a 80% probability. I'm putting 50% of my account on this trade. We're going to new lows. No. Why not? Because do I want to risk half my account on one trade, even with 88% probability? No. That would be ludicrous. Now I'll risk half your account. Just kidding. Yeah. If it was just a game, I've thought about doing that to train traders, is figuring out how to gamify charts without them knowing what it is, or that what it even representing in a different way. I've been playing with that concept for years because you could literally convert it. And I'm not talking the AMC apes or whatever these people who are trying to play this short. That's not really the game I'm talking about. I'm talking about turning it into a probability video game, which you could probably develop some superstar traders based off of that if you stripped away all other information. But that's another topic. Yeah, for anyone interested, YouTube, Mike and Bob have a how-to series, great content on harmonics and setting up your GAN boxes and harmonics. Yep. So there we go. I hope everyone has a great weekend. By the way, sorry for no analysis. We'll just do all our market analysis on Sunday. I thought this was more important right now with everything that's going on with everyone, and want to get some concepts through people's heads so they can go into the weekend. And if you're sitting there tonight and it pops in your head, think about this stuff that we talked about today. Think about it, and we can come back Sunday and do our market analysis and go from there. So as a scalper, I track time in each of the 5-minute increments. Nearly 95% of trades that last longer than 15 minutes are losers, whereas those that are less than 10 minutes are winners, about 80%. So therefore, based off the what your entries that you have, you're not going to use those same entries on 1-hour charts, are you? No. They're only scalping entries. And there are only scalping entries. Just like there are patterns on a daily chart that I wouldn't trade as a scalper. So your probabilities based off of your entries and your time frames. So don't mix them up. Hey, Ken, thank you. Have a good weekend. Definitely not. Again, yes, agreed. Nice tracking. This is where the more you track, the more data you have. The more data you have, the better trader/investor you can be. I'll leave it at that. Again, everybody have a great weekend. If you're new here, please do consider subscribing if you've enjoyed this content. Ring the bell and hit that like button and give me some feedback. Again, especially in these more limited series, if some of the longer term viewers could come back and leave some comments, what you liked or disliked about this classroom session, it'll help it get wider distribution, and hopefully we can help some of the people that are caught up in some of these improper trading techniques and mindsets and get them into more of a professional mindset. Whatever method you trade, there's still going to be probabilities and reward to risk and time frames. So we need to get that out there for people. So again, share this with everybody, and share this with your friends, share this with family. Even if they're just investors, have them hear some concepts out there that they might not have considered. And I'll talk with everybody later. Have a